If you observe carefully what's happening in the banking system right now, you'll notice something extraordinary. Central banks worldwide are quietly implementing policies that will fundamentally change the relationship between you and your money. In the last 18 months, global central banks have purchased over 100 metric tons of physical gold, the highest rate in over 50 years. When the institutions that create money start protecting themselves from money, you need to pay attention. What I'm about to share will affect every dollar you have sitting in a bank account, and the window to protect yourself is narrowing faster than most people realize. This isn't a prediction. It's a logical consequence of policies already in motion. I've spent over 40 years studying economic cycles and the patterns that emerge when governments face unsustainable debt burdens. When you understand incentives, you understand behavior. Right now, governments worldwide face an impossible mathematical problem. The United States federal debt stands at $38 trillion, with annual interest payments exceeding $1 trillion. European banks hold over $600 billion in unrealized losses. Japan's debt to GDP ratio has surpassed 260%. These aren't abstract numbers. They're constraints that force specific behaviors, and those behaviors will directly impact your savings in ways most Americans haven't considered. The fundamental mechanism is actually quite simple. When governments accumulate debt they cannot repay through normal growth or reasonable taxation, they face three choices: default outright, implement severe austerity, or devalue the currency through inflation. History shows governments almost always choose the third option because it's politically palatable and mathematically hidden. Think of it like a dam holding back water. The government can reinforce the dam with higher taxes, but that's politically painful. They can open the floodgates and let debt default, causing immediate catastrophic damage. Or they can slowly release water through controlled channels, creating inflation that erodes the real value of both the debt and your savings simultaneously. Currently, the U.S. Treasury faces $6 trillion in debt that must be refinanced between 2024 and 2026, much of it issued during near zero interest rates. That debt will be rolled over at rates 500 basis points higher, creating immediate fiscal crisis that forces the Federal Reserve's hand toward accommodative policy regardless of inflation levels. Simultaneously, Social Security faces $75 trillion in unfunded liabilities, with the trust fund projected depleted by 2033. The mathematical pressures are building, and the release valve they'll use is your purchasing power. History is an excellent teacher. In 1971, President Nixon closed the gold window because the United States couldn't maintain the peg while funding domestic programs and the Vietnam War. Within 3 years, inflation surged to over 12%. A family with $50,000 in savings in 1971 found that by 1980, that same $50,000 could only purchase what $18,000 would have bought 9 years earlier. They didn't lose money in their account. The balance stayed the same, but the value dissolved like sugar in hot water. The Weimar Republic in the 1920s provides an even starker example. German citizens who trusted their savings in banks denominated in marks found that by 1923, a wheelbarrow full of currency couldn't buy a loaf of bread. Families that had spent generations building wealth were financially destroyed in less than 18 months. More recently, in 2013, Cyprus implemented a bail-in where the government simply confiscated deposits above $100,000 from bank accounts to recapitalize failing banks. Overnight, business owners and retirees lost 5% of their savings above that threshold. In Argentina's 2001 Corralito, the government froze bank accounts and forcibly converted dollar deposits to pesos at unfavorable rates, causing citizens to lose 66% of their savings value within months. These aren't ancient anomalies. This is the standard playbook when governments face the mathematical constraints we're seeing right now. To understand what's coming after 2026, you need to understand three fundamental principles. The first is the debasement incentive. When a government owes debt in a currency it controls, it always has the option to print more of that currency to service the debt. Think of it like a restaurant that owes money to suppliers. If the restaurant could legally print its own money to pay those suppliers, why would it ever close down? Right now, the Federal Reserve's balance sheet remains elevated at over $7 trillion despite promises to reduce it, and deficit spending continues at $1. 7 trillion annually even during economic expansion. The incentive structure is clear. Those who control the monetary spigot will use it when mathematical constraints become binding. The second principle is financial repression. This is when governments systematically channel citizen savings into government debt at interest rates below true inflation. After World War II, the United States and Britain both utilized this to reduce massive war debts. They maintained interest rates at 2-3%, while actual inflation ran at 4-6%. Over 2 decades, this quietly transferred wealth from savers to government, reducing debt burdens from over 100% of GDP to manageable levels. Think of it as a seesaw. On one side sits the government's debt burden. On the other side sits the real value of citizens' savings. Financial repression is the mechanism that slowly tips the seesaw, lifting the government's burden while pressing down on your savings. We're already seeing early stages. Regulations encouraging banks to hold government bonds, pension funds push toward Treasury securities, and savings account interest rates that consistently trail inflation by 2 to 3 percentage points. After 2026, as debt refinancing pressures intensify, these mechanisms will accelerate dramatically. The third principle is currency competition. For the first time in 80 years, the dollar faces legitimate alternatives as global reserve currency. Central banks worldwide are diversifying away from dollar holdings. China and Russia have reduced Treasury holdings by over $500 billion since 2021, while increasing gold reserves by 400 metric tons. The BRICS nations are actively developing alternative payment systems that bypass the dollar entirely. This matters because the dollar's reserve status has allowed the United States to run deficits and print money with fewer immediate consequences. It's like being the house in a casino. You can take on more risk because you control the chips. But when players start using different chips, the house advantage disappears. After 2026, as other nations accelerate de-dollarization efforts, the United States will face much tighter constraints, forcing more aggressive domestic measures that directly impact bank depositors. The canary in the coal mine is already singing. When Saudi Arabia begins accepting yuan for oil payments, when the European Union explores a digital euro, when your own Federal Reserve talks about central bank digital currencies that could replace traditional bank deposits, these are signals the landscape is shifting fundamentally. Let me tell you a story about 2 families during the 2008 financial crisis, because their outcomes illustrate exactly what we're discussing. The Thompson family, Tom and Sarah, both 55 in 2007, had diligently saved $680,000, kept primarily in bank savings and CDs earning 4 to 5% interest. They believed they were being conservative and prudent. They trusted the banking system, trusted FDIC insurance made their deposits safe, and felt keeping money liquid was responsible. When 2008 hit, their deposits were indeed protected by FDIC insurance. They didn't lose a single dollar of principal. But here's what happened. The Federal Reserve dropped rates to near zero to bail out the financial system. The Thompsons' $680,000 earned perhaps 5 to 1% annually between 2009 and 2019. Meanwhile, actual inflation in housing, healthcare, education, and food ran between 4 to 6% annually. Their savings weren't growing with massive asset price inflation occurring in stocks and real estate. By 2019, their account still showed $680,000, but accounting for inflation and opportunity cost, the real purchasing power was equivalent to perhaps $420,000 in 2007 dollars. They had lost $260,000 in real wealth over 12 years without ever seeing a negative number on their bank statement. When Tom retired in 2020, they discovered the retirement lifestyle they'd planned. Travel, helping grandchildren with college, comfortable living, wasn't financially feasible with what their savings could actually purchase. Now contrast the Martinez family, Carlos and Elena, same age, similar $650,000 by 2007, but they had studied monetary history and understood these patterns. In late 2008, as crisis unfolded and the Federal Reserve signaled aggressive monetary expansion, they made different choices. They kept $50,000 in bank accounts for liquidity and emergencies. They moved $150,000 into physical precious metals, primarily gold and silver coins stored securely. They invested $300,000 into dividend-paying stocks of companies with strong balance sheets and pricing power. They put $100,000 into income-producing real estate through REITs and direct property ownership. Finally, they allocated $50,000 into Treasury inflation-protected securities. This wasn't gambling or speculation. It was positioning assets to preserve purchasing power during monetary expansion. Over the next decade, the gold component increased by approximately 140% from $900 per ounce to over $2,100 by 2024. Their dividend stocks provided both income and appreciation, growing approximately 180%, including reinvested dividends. The real estate component appreciated roughly 85% while producing income. The tips maintained real value. By 2019, their total portfolio was worth approximately $1, $35 million. More importantly, this represented actual purchasing power growth, not just nominal growth. When Carlos retired in 2020, they had nearly doubled their real wealth, while the Thompsons had lost nearly 40% of theirs. This isn't made up. It's the typical pattern when you position assets to survive monetary debasement rather than trusting banking deposits will preserve value. Now let's translate this to what really matters, how this affects you specifically. If you're 55 years old with $500,000 in savings sitting primarily in bank accounts, money market funds, or short-term CDs, here's a realistic scenario over the next 5 years based on current policy trajectories. The Federal Reserve currently maintains interest rates in the 4 to 5% range, and your savings might earn that temporarily. But as debt refinancing pressures mount in 2026, 2027, and government needs to service $10 trillion plus in debt at higher rates, political pressure to cut rates becomes overwhelming. The Fed will claim they're responding to economic weakness or preventing banking crisis, but the real driver is fiscal necessity. The government mathematically cannot afford to service debt at high rates. By 2027, we likely see policy rates back near 1 to 2%, meaning your $500,000 earns perhaps $10,000 annually before taxes. Meanwhile, real inflation in goods and services you actually purchase, food, energy, healthcare, insurance, property taxes, runs at 6 to 8% annually, though official statistics might report only 3-4%. Over 5 years at 7% real inflation, your $500,000 needs to grow to $701,000 just to maintain the same purchasing power, but earning only 1. 5% means your balance grows to just $538,000. The gap, $163,000, represents purchasing power you've lost despite doing everything the conventional financial system told you was safe. Let me make this even more concrete with monthly expenses. Today, if your household expenses are $6,000 monthly, you might feel comfortable that your $500,000 provides substantial cushion. But if real inflation runs at 7% annually while your savings earn 5% by 2029, those same household expenses will require $8,400 monthly, while your savings have grown to only $538,000 nominally, but represent only $383,000 in today's purchasing power. You're not broke, but you've lost over 5 years of retirement security without ever receiving a letter from your bank saying, "We're confiscating your wealth." It happens silently, mathematically, inevitably. Based on these principles, here are practical guidelines. For someone holding between $250,000 and $2 million in investable assets, which describes a large portion of American retirement savers, a protective allocation might look like this: 30% in physical precious metals, split between gold and silver, held securely outside the banking system. This isn't speculation on gold prices. It's recognition that gold has maintained purchasing power across every currency debasement in human history. Another 25% in high-quality dividend-paying stocks concentrated in companies with pricing power, strong balance sheets, and essential goods or services. Think consumer staples, energy infrastructure, utilities that can pass inflation through to customers. Another 20% in income-producing real estate, either direct ownership of rental property or through carefully selected REITs, focused on essential real estate like medical facilities, essential retail, or industrial properties. These provide both inflation protection through rent increases and tangible assets that can't be debased. Another 15% in short to medium-term Treasury inflation-protected securities, which at least maintain nominal purchasing power even if they don't provide real returns. Finally, 10% in genuine liquidity, bank deposits, or money market funds for emergencies and short-term needs. This isn't about making money. It's about not losing money in real terms. What to avoid is equally important. Avoid long-term bonds at current yields, especially government and corporate bonds with durations over 5 years. These are return-free risk in an environment of fiscal dominance and potential inflation. When inflation rises and currency debases, long-term bonds get destroyed. Avoid keeping more than 10–15% of total assets in traditional bank deposits beyond what you need for liquidity. The risks have shifted from bank failures, which FDIC insurance covers, to currency debasement, which FDIC doesn't cover. You get all your dollars back, but those dollars buy much less. Avoid annuities and fixed pension products denominated in nominal dollars unless they have robust inflation adjustments. An annuity promising $50,000 yearly sounds secure until you realize that in high inflation, $50,000 in 2030 might purchase what $28,000 purchases today. Implementation matters as much as allocation. This isn't something you do overnight. If you currently have $600,000 sitting in bank accounts and CDs, don't liquidate everything Monday morning. That's how people make mistakes, overpay for assets, and act emotionally. Instead, create a systematic 12-month implementation plan. Month 1, establish your precious metals position. Buy physical gold and silver coins from reputable dealers. Arrange secure storage outside the banking system. Months 2 through 4, research and begin building your dividend stock portfolio, perhaps buying 2 or 3 positions monthly, focusing on quality over speed. Months 5 through 7, explore real estate options, whether direct property investment or REIT positions. Months 8 through 10, establish your TIPS position to provide nominal protection. Months 11 through 12, review and rebalance, making final adjustments. This gradual approach accomplishes several things. It averages your entry prices across different market conditions. It gives you time to learn and become comfortable with each asset class, and it prevents the emotional paralysis that often stops people from acting at all. Nothing in this constitutes specific financial advice for your individual situation. Each person has different circumstances, risk tolerances, time horizons, and tax situations that materially affect what's appropriate. What I've described are general principles and patterns based on historical analysis of monetary systems under stress. You should absolutely consult with qualified financial professionals who understand your complete personal situation before making significant financial decisions. The choice is yours. But remember what we've observed. When central banks worldwide purchase over 2,100 tons of gold in 18 months, they're making a statement about confidence in paper currency systems. When the Bank of International Settlements issues warnings about sovereign debt sustainability, they're observing the same mathematical constraints we've discussed. When pension funds and insurance companies begin increasing alternative asset allocations away from government bonds, they're responding to the same incentive structures. The institutions that create money are protecting themselves from money. The institutions that manage government debt are warning about government debt. The institutions that have benefited most from the current system are quietly repositioning for a different system. That's why this channel exists. to help ordinary Americans who spent their lives working, saving, and doing what they were told was responsible understand the broader forces that will determine whether that lifetime of work translates into actual retirement security. We observe signals before they become obvious. We study patterns across centuries and across countries to identify what's probable rather than what's merely possible. If this analysis makes sense to you, if you found value in understanding these historical patterns and monetary mechanisms, consider subscribing to this channel. We'll continue analyzing these developments as they unfold, helping you navigate what will likely be the most significant monetary transition of our lifetimes. The window for action exists today, but windows don't stay open indefinitely. You now have the understanding. The action remains your choice. Incognito chats aren't saved to history or used to train models.